Every year, the government offers you free money back. Not a gift, not a lottery, not something you have to qualify for by being wealthy or clever. Just money that is legally yours, that most employees never collect, because nobody told them it existed. The average employee leaves between $400 and $1,500 on the table every single tax season. Not because they cheated, not because they missed a deadline, because they filed their taxes the same way they always have, and assumed the system would do the rest. It does not. This video is the conversation your employer never had with you. Let me tell you about Kai. Kai is 27. He works a full-time office job. He makes $54,000 a year. Every February, his T4 arrives, or his W-2 if he is in the US, and he opens a free tax software, punches in the numbers, submits, and waits to see if he gets a refund or owes money. Most years, he gets a small refund, maybe $200, sometimes $300. He puts it in his account and moves on. What Kai does not know is that last year, he was eligible for over $900 in additional refunds that he never claimed. He worked from home 3 days a week and never claimed the home office deduction. He bought a transit pass every month and never claimed it. He upgraded his laptop for work and kept the receipt, but never connected it to his return. His union dues were deducted from his pay all year. He did not realize they were claimable. Not dramatic mistakes, just gaps in knowledge. And those gaps cost him $900 last year alone. If you are an employee who files their own taxes without much thought, Kai is probably your story too. Not because you are careless, but because tax literacy is not taught. Not in school, not at your job, not by the software that asks you yes or no questions and assumes you know what they mean. Today, I am going to close those gaps, one deduction at a time. Before I walk you through what you can claim, let me make sure you understand what a tax deduction actually does, because most people think of it as cash back, which is not quite right. A deduction reduces your taxable income, not your tax bill directly, your taxable income. Here is the simplest way to think about it. You earn $54,000 a year. The government taxes you on that $54,000. But if you have $3,000 in eligible deductions, the government now taxes you on $51,000 instead. That $3,000 that disappeared from your taxable income, you are taxed on it at your marginal rate. If your marginal rate is 30%, you save $900. If it is 26%, you save $780. That is money that comes back to you, either as a refund if you overpaid or as less tax owed at filing time. A tax credit works differently. It reduces your actual tax bill directly. Credits are even better than deductions. We will get to those too. But the key point is this. Every dollar of deduction you miss is a dollar. Your income is taxed on unnecessarily. You earned the money. You worked for it. The government is legally telling you, you do not have to pay tax on this particular dollar, but only if you tell them about it. Most people do not tell them, so they pay. Let me walk through the deductions most Canadian employees miss. I will cover the US side in just a moment. Deduction 1. The RRSP contribution. This is the biggest one and the most commonly underused. In 2026, you can contribute up to $33,810 to your RRSP, or 18% of your prior year's income, whichever is less. Every dollar you contribute to your RRSP is deducted from your taxable income directly. That is not a credit. That is a deduction. If you earn $60,000 and contribute $5,000 to your RRSP, the government taxes you on $55,000 at a combined federal and provincial marginal rate of around 33%. That $5,000 contribution saves you roughly $1,650 in tax immediately, and the investment inside the RRSP grows tax-free until you withdraw. The reason most people undercontribute is simple. They do not know how much room they have. Your notice of assessment from the CRA tells you your exact RRSP contribution room. Log into CRA My Account. It is right there. You also have unused room that carries forward from previous years. If you have been working for 5 years and barely contributing, that unused room has been accumulating. Use it. Deadline to contribute for the 2025 tax year, March 2nd, 2026. Deduction 2. Employment expenses, T2200. This is the one that Kai missed. This is the one most employees do not even know exists. If your employer required you to work from home or to pay for expenses to do your job, and your employer has signed a T2200 form confirming this, you can claim those expenses on your return. This includes home office expenses, a portion of your rent, utilities, and internet proportional to the space you use for work, office supplies you personally paid for, pens, paper, printer ink, a cell phone used for work, the portion of your bill that relates to work, a work-related computer or tablet, if you paid for it yourself and your employer required it. How much can this be worth? It depends on your situation, but a person who worked from home 60% of the time in a one-bedroom apartment in Toronto, paying $2,200 a month in rent, could claim roughly $1,500 to $2,000 in home office expenses alone. The key is getting the T2200 signed by your employer. Most employers will sign it. Most employees never ask. Deduction 3. Union and professional dues. If you pay union dues, professional association fees, or licensing fees required for your occupation, these are fully deductible. Nurses paying their professional nursing license, electricians paying union dues, teachers paying professional association fees. These are deducted from your pay throughout the year, but they still need to be claimed on your return to get the tax benefit. They do not claim themselves. Your T4 will show them in box 44. They go on line 21,200 of your return. If you earn $55,000 and pay $1,200 in union dues annually, that is a deduction you might be missing entirely. Deduction 4. Moving expenses. If you moved at least 40 kilometers closer to a new job or post-secondary school, you can claim your moving expenses. This includes transportation, storage, temporary accommodation up to 15 days, and even meals during the move. This one surprises people. They moved for a job 2 years ago. They had expenses. They assumed you could not claim that. You can. Deduction 5. Childcare expenses. If you have children under 16 and you paid for daycare, a nanny, summer camp, or after-school programs so you could work, those expenses are deductible. The limit is $8,000 per child, under 7 and $5,000 per child, age 7 to 16, claimed by the lower-income spouse. This is a substantial deduction that many families claim incompletely, missing summer camps and programs that qualify. For my U.S. viewers, here are the deductions most employees miss. The standard deduction versus itemizing. First, the basics. In the U.S., you choose between the standard deduction, which for 2025 is $15,000 for single filers and $30,000 for married couples filing jointly, or itemizing your actual deductions. Most people take the standard deduction without checking whether itemizing would give them more. If your mortgage interest, charitable donations, and state taxes paid total more than the standard deduction, itemizing wins. Run both numbers. Student loan interest. You can deduct up to $2,500 in student loan interest paid during the year, even if you take the standard deduction. This is an above-the-line deduction, meaning it reduces your taxable income regardless. If you have been paying down student loans and missing this, go back and check your prior returns. You may be able to amend. Educator expenses. Teachers and eligible educators can deduct up to $300 in out-of-pocket classroom expenses, or up to $600 for married couples who both teach. This includes supplies, books, and equipment, also above the line. Health savings. Account contributions, if you have a high deductible health plan at work and you or your employer contribute to an HSA, those contributions are deductible. The 2025 limit is $4,300 for individual coverage. Contributions made outside of payroll are deductible even when taking the standard deduction. Traditional 401k and IRA contributions. Contributions to a traditional 401k reduce your taxable income dollar for dollar. For 2025, the employee limit is $23,500. Many employees contribute just enough to get the employer match and stop. If you have capacity to contribute more and you are not at the limit, every additional dollar reduces your taxable income now and grows tax deferred until retirement. Let me show you what the numbers look like when you actually claim what you are entitled to. Back to Kai in Canada. $54,000 salary. 30% marginal tax rate, combined federal and provincial, without claiming any additional deductions. Taxable income, $54,000. Tax owed, approximately $16,200 at effective rate. Now with deductions, he actually qualifies for RRSP contribution, $4,000. Union dues, $900. Home office expenses, T2200, $1,800. Total additional deductions, $6,700. New taxable income, $47,300. Tax saved, $6,700 times 30% equals $2,010. That is $2,010 back. Not from finding a loophole, not from creative accounting, from claiming what the government explicitly says he can claim that he just never claimed. Last year, Kai got a $200 refund. This year, if he claims everything, he is looking at over $2,000. Now imagine he does this every year. $2,000 extra per year invested in his TFSA at 8% average annual return. After 10 years, approximately $31,000. After 20 years, approximately $99,000. From claiming deductions he was already entitled to, every single year. This is not a tax trick. It is not aggressive tax planning. It is just using what was already yours. Step 1. Log into your tax account and know your numbers. Canada. Log into CRA My Account at Canada.ca. Check your RRSP contribution room. Check your TFSA room. Look at your notice of assessment from last year. US. Log into IRS.gov or use the IRS free file tool. Review your prior year return and note what you claimed and what you did not. Step 2. Get your T2200 from your employer, Canada. If you worked from home at any point this year, or if you incurred any work-related expenses, email your HR department and ask them to complete a T2200 form for you. Most employers will do it. Most employees never ask. Step 3. Gather your receipts. For the current tax year, start keeping digital copies of union dues statements, professional association invoices, any work-related purchase you personally paid for, transit receipts, moving expenses if applicable, childcare receipts showing the provider's name and SIN/EIN. A free folder on Google Drive or your phone's Notes app is enough. The habit takes 5 minutes a month. The refund can be thousands of dollars. Step 4. Use software that asks the right questions. Canada. Wealthsimple Tax is free and asks specifically about employment expenses, RRSP contributions, union dues, and other commonly missed items. TurboTax and H&R Block also walk you through these step by step. US. TurboTax. H and R Block or Free Tax USA all help you identify commonly missed deductions. If your situation is straightforward, Free Tax USA is free for federal filing. Step 5. Consider amending prior years. In Canada, you can go back and amend returns up to 10 years. In the US, you can amend the last 3 years using Form 1040-X. If you have been missing deductions for multiple years, this is worth doing. A tax professional can often find significant amounts in past returns for a modest fee. Here is the reframe I want you to leave with. Most people think of taxes as a fixed bill. The number on the screen is what you owe. You pay it. Done. It is not. The tax code is a set of rules. And like any set of rules, knowing them gives you an advantage. Ignoring them does not make them simpler. It just means you pay more than you have to. The government is not hiding these deductions from you. They are listed. They are public. They are in the same documents your accountant reads. They are in the same system your employer navigates. The only difference between the person who gets $200 back and the person who gets $2,000 back on the same salary is knowledge. Not wealth, not luck, not a special connection, just knowing what is already yours and claiming it. You are not asking for a favor when you claim a deduction. You are doing what the law explicitly allows. And every dollar you do not claim is a dollar you worked for that the government keeps, not because they are entitled to it, but because you did not know to ask for it back. Tax season does not have to be the time of year where you punch in numbers and hope for the best. It can be the one time of year where you sit down, look at your actual situation, and take back what is already legally yours. RRSP contributions, employment expenses, union dues, moving costs, childcare, student loan interest, HSA contributions. These are not tricks. They are not loopholes. They are deductions the government created specifically for people like you, working adults with ordinary jobs and ordinary expenses who deserve to keep more of what they earn. You just needed someone to tell you they existed. Now someone has. Drop a comment below and tell me, which of these deductions have you been missing? Have you been claiming your RRSP room? Have you ever asked your employer for a T2200? Have you been filing as if your taxes are simple when there might actually be more on the table? I read every comment. Give me your situation, salary range, whether you work from home, any big expenses this year, and I will tell you specifically what to look at. If this video helped you see your tax return differently, share it. Share it with a friend at work who complains every February about owing money, because the fix might be simpler than they think. Subscribe to NuellaInvests. Every week, we cut through the financial information that should have been taught to you years ago and was not. I will see you in the next video.